Hey everyone, my name is Jack. Welcome back to the channel. I cover a variety of topics as they relate to investing, personal finance, real estate, and all that sort of stuff. So if you like that sort of content, be sure to have a look around the channel. And if you like what you see, be sure to subscribe. But today I want to go over a very simple retirement plan for those who might be getting started with retirement investing or maybe don't know where to start. This should be a helpful guide for getting up off your feet and actually starting your retirement plan. Now I have to emphasize that I am not a financial advisor, and this video should not be taken as financial advice. I'm just a guy on YouTube, and you shouldn't trust guys on YouTube. Now, I call this strategy the 5-minute retirement plan because it really doesn't take very much time at all to set up. Now, I understand that this video is longer than 5 minutes, and that's because I'm explaining concepts and different rules with retirement investing, which I'll get into in this video, but that's why this video is longer than 5 minutes. Otherwise, it really should not take you very long at all if you follow the steps in this video. But of course, if you're unsure about something, definitely check with a licensed financial professional to get their advice. Now, before I actually get into the steps on how to execute this retirement plan, I want to go over what an IRA is. An IRA is an individual retirement account. It's where you can invest for your retirement and you get a number of tax benefits depending on the type of account that you use. One of those is the traditional IRA and another is the Roth IRA. Now, I have a video on my channel already going over the differences between a Roth and a traditional retirement account, so I'll go ahead and link that above right now. But just the quick rundown is a Roth IRA is one where you pay taxes now, contribute the money into the IRA, let it grow over time, and then when you pull the money out in retirement, you don't pay any taxes on anything. That's because you already paid the taxes up front, so you don't end up paying the taxes later. So that's great when you have a low tax basis. In other words, if you're not making a lot of money now, it makes sense to just pay your low taxes right now while they're low, put the money into the retirement account, and then hopefully if you're making more in retirement because you're such a diligent saver and you have a lot of money invested and you would be pulling out a salary that ends up putting you in a higher tax bracket later on, then you won't be facing higher taxes because you already paid the taxes on the money that you put into the account. Now, on the other hand, is a traditional retirement account. This is where you invest the money now into your account and then you get a tax deduction on that given tax year that you invested the money in. But unfortunately, when it comes time to actually withdraw that money from your retirement account, you have to pay taxes on it. So you're paying taxes later as opposed to now. Now, which type of IRA you choose, a Roth or a traditional, totally depends on your specific tax situation. You might want to talk to a licensed tax professional, ideally, to figure out which one makes the most sense. But generally speaking, if you're not making a lot right now and you have a low tax bill, it probably makes sense to use a Roth. And that's usually a good option for someone in their 20s who might just be starting their career. I have a Roth IRA, and that's where I put almost all of my retirement investing. That is, the retirement investing within an IRA. It's in a Roth IRA for me. But if you're making a lot of money right now and you're in your peak earning years and your tax bill is very high, it might make sense to take the deduction now and then hope that your taxes are much lower further down the line. And then you could use that tax deduction savings to invest into something else. So you could even compound your savings that much further. Now, annual contribution limits for IRAs are actually $6,000 per year across all of your IRAs. So if you have both a Roth and a traditional IRA, you can only contribute up to $6,000 per year for all of those. So you could split it $4,000 in one account and $2,000 in another, but you can't do $6,000 per account. It's $6,000 total across all of your IRAs. Now that you understand the basics between a Roth and a traditional IRA, it'll be up to you to decide which one you actually want to go with. But for now, I want to actually go through how to open up an IRA so you can actually get started with retirement investing. So I'll jump over to my computer right now and I'll walk through the steps of opening an IRA. So this is M1 Finance. It's a free stock brokerage that I really like to use, and you can actually open up retirement accounts in it. So that's what I'm going to do right now. I'm going to go here to add account after you open up a general account with M1 Finance. It's really easy to do. It's free, but you go down here, add account. Retirement will be the one that I'd want to add. So here it is, retirement, and then it'll take you to your retirement account options. And then you have the option between a traditional IRA, a Roth IRA, a SEP retirement plan, which is for self-employed folks, and then you could also roll over a 401k if you happen to have one from a former employer, and then you can put that into an IRA if you already have one with M1 Finance. So I actually don't have an IRA with M1 yet. The IRA that I have is actually with Vanguard, and you can certainly use Vanguard or really any brokerage out there. They pretty much all offer IRAs, and basically all of them should be free. If they're not free, then definitely look into a free option since there's tons out there and it doesn't really matter too much what brokerage you use. I just like M1 Finance because it's really intuitive and really easy to use. So what I'm going to do here is actually open up a traditional IRA since I already have a Roth IRA through Vanguard, and the investments that I would make in this wouldn't be really any different than Vanguard's anyways, but I would like to have a traditional IRA ready to go in the event that maybe I get a lump sum of cash from some deal or something where my taxable income is much higher in 1 year, so it makes sense to take a tax deduction rather than paying taxes now like I would with the Roth. So just best to probably have one of each in my case, since my income's probably going to fluctuate a good bit in the next handful of years, if not the next many years. We'll see, but I'm going to open up a traditional IRA now. So you'd go here, and then you would agree to all of these disclosures, so I'm going to read through those now, and I'll cut back. All right, but in general, everything with M1 Finance is free, which is great. So even if you don't actually want to use this IRA, if you don't have one already and you end up opening an account with M1 Finance, you don't have to use it. It's free. So it's no harm to really have it open. So I'm going to go ahead and confirm. And it's ready to go. I have my traditional IRA ready to go. They already had my information from my other accounts, so it's a little bit quicker. You're probably going to have to enter things like your social security number, your address, your name, all that stuff. But I have this thing ready to go, so now I have to figure out what to put in this IRA. What am I going to put in here? So you can actually do a few things on M1 Finance. You can create your own pies or portfolios. They call them pies, but it's the same thing. You pick the stocks or funds that you want to put in here. You could also browse M1 Finance's expert pies that they put together themselves. And then you can also do your own research to just pick individual stocks if you don't want to do a whole a sort of fund. But you can put together a few stocks into this sort of pie, and then you kind of have your own little index fund in there if you want to do that. So I actually already created one, so I'm going to go to View Pies. Then I have the 5-minute retirement plan right here is what I put together. This is super, super, super simple. It is not very complex. All it is 2 index funds. It's the Vanguard Total World Stock Index Fund and then the Vanguard Total World Bond Fund. So what this is, based here, we can take a look right here. Vanguard Total World Stock Index Fund. This is a small share of basically every single stock in the world that at least is publicly traded. So that's over 8,000 holdings. There are more stocks out there, I'm sure, but this is basically all publicly traded stocks in the world. And that's great for diversification. So diversification allows you to have a situation where if one stock goes down, you would have thousands of others to make up for that loss. But at the same time, if a stock goes up, there's a high chance you're going to have stocks that go down as well. So you typically get a fairly stable return compared to, say, putting all of your money in one stock like Tesla, for example. It might do very great in 1 month and then do terrible in the next month. And over the long run, it's going to jump up and down really violently compared to something like this giant index fund, which at least over the past few years, has steadily trended upwards. But like anything in the stock market, it's going to bounce up and down. It won't bounce up and down as violently, usually, as when you're just buying one stock. Because at any given point, there's usually at least a few stocks that are doing well, and there's usually a few stocks that are doing poorly. And over the long run, at least as it's always been with large index funds, is there are more stocks that do better, or at least more value is created in the stock market than is lost over the long term, and that's usually what happens. So what you're really doing with a portfolio like this is you're getting total diversification to where you should have fairly consistent returns if history is at all telling. And history has shown that the World Stock Fund has made about 6 to 7% per year over its existence for about a couple decades now. So you have pretty good odds that things are going to keep going up pretty steadily. Now, you're not going to have the biggest returns ever because, again, you're carrying very poor stocks as well. You're carrying all stocks. You're not doing any research into picking what stocks you're doing. You're just getting everything. You are betting that the world economy is going to be in a better place many years from now than it is now, which, at least through history, has been a great bet to make since thankfully human innovation keeps pushing us forward, companies keep getting better, and there's more value created throughout the world as we move forward. Now, the tweak you can make if you still want a really diversified portfolio, but not this diversified geographically, is you can get something like a total stock market fund for the US, and Vanguard has one of those that's on M1 Finance as well. You can pick all sorts of giant index funds that covers all sorts of things, but if you did that, you'd be very skewed towards the US, which has done very well in the past few decades, better than the World Stock Index Fund, but there's no telling that the US is going to continue leading the stock market in the near future. We'll see what happens. Maybe it will, and there's a good chance that it will, but if you want to really diversify geographically and don't want to put all your eggs in one country's basket, you can do that by using this 5-minute retirement plan. And I should cover this other holding right here. This is the Vanguard Total World Bond ETF. If you don't want any bonds in your portfolio, because let's say you're in your 20s and you got many years towards retirement and you don't plan on touching this for many decades, then you don't really need bonds, I don't think. They do help with limiting your risk since they are generally less risky assets. A bond is basically a loan that you give to a company, and the reason that they're less risky than stocks is because in the event that a company goes bankrupt, the first people to get paid are the bondholders or the debt holders of a company, as opposed to the shareholders who hold the stock. So because of that, if a company goes bad, you still have a much higher chance of getting your money back. So that also means that your returns won't be as high over the long run. But this is tons and tons of bonds. It has a bunch of bond funds within the fund, so you get all sorts of bonds from all sorts of different companies from all over the world. So you get diversification in the bond market as well. Let me go back to this page here to build your portfolio. I would hit View Pies. I click on this to add to the basket, and then this would be added as a 100% allocation of this fund. I'd hit Save, and then it should be in the IRA once it finishes loading, and yes, it is. So now all I would have to do is make an initial deposit. You can deposit up to $6,000 per year in 2020, and that is always subject to change, but it probably is going to be that for the foreseeable future. So I can put $6,000 into this IRA if I wanted to, and then that would mean I'd get a $6,000 tax deduction on the year because this is a traditional IRA. But then with a traditional IRA, again, I'd have to pay taxes on the withdrawal at the very end. So I would eventually pay taxes on that theoretically. And then with a Roth IRA, you pay the taxes now and never pay taxes again. So it depends on your current tax bill and what you think your future tax bill will be when you're making that decision. But anyways, that's it. I have my IRA ready to go. And now what I would do is I would set up automatic deposits. And you actually set up recurring deposits on M1 Finance to where you can have $500 per month, for example, going to this account and never touching it again. $500 a month would mean $6,000 per year, and that would mean your retirement would automatically be getting funded, and you wouldn't really have to touch anything until you retire unless you wanted to make adjustments for whatever reason, but you wouldn't need to. That's it. That's the 5 minutes. You set up your recurring deposits after you set up your IRA and the holdings in it, and then that's it. You will automatically have money deposited into the account, and then it will keep going from there. And the cool thing about M1 Finance is all the money going into it will automatically be rebalanced. And that's because it's always going to try to maintain this allocation here, this 90% target and this 10% target, or whatever you adjust it to if you want more bonds or less bonds or no stocks at all. It totally depends on what your preference is for investing. Definitely talk with a financial advisor if you're at all confused or want some advice. But the cool thing about M1 Finance is as new cash is put into this account, it will go towards the underweighted section of your portfolio automatically without you having to do anything. So it's a really cool brokerage for hands-off investing or really just for long-term investing without needing to micromanage everything to make sure that you're allocated correctly. But again, you don't have to use M1 Finance. I use Vanguard for my Roth IRA. You can use all sorts of stock brokerages to open up IRAs. A lot of banks offer them as well. So there's no limit on what company to use for an IRA. Just make sure they're legitimate, obviously, and make sure that you're not paying unnecessary fees, since it really should be a free option basically everywhere now. So I'll go ahead and include a couple links in the description so you can set up this 5-minute retirement plan for yourselves. So there will be a link to open up your M1 Finance account. It's an affiliate link through my account, so if you end up funding it, then I might get a small affiliate commission, but it's of no extra cost to you. So you'd set up your account through there. Then you would actually add this pie with the world stock and total bond index that you can actually copy directly into your portfolio without even having to do the research yourself. You can actually just copy it right into your portfolio that if you want that. Again, I'm not a financial advisor, but it's at least a quick option to get started. And if you want to adjust it, you can, or add different stocks to it, totally up to you. And then you would actually just copy that pie into your portfolio, and then you'd start funding it with a recurring investment, and then you're all good. So those 2 links are in the description below. One to open up your account, and then another to actually copy this specific pie into your new account. And if you already have an M1 Finance account, you could still copy this pie. It's ready to go, and you could put it into whatever portfolio you want. It doesn't have to be in an IRA. They offer taxable brokerages here on M1 Finance as well. I actually have a whole series documenting my investments on M1 Finance. So if you're at all interested in stock investing, or maybe you just want to learn more about different investment strategies, definitely check out these series that I'll link above right now. But that's really all there is to it. If you want to use M1 Finance, the links are down there in the description. You can use whatever brokerage you want to do, but that's pretty much it. You set up the IRA, you take some broad index fund or some sort of simple approach to investing, and then you consistently add money to that every single year thereafter. And those consistent investments really add up when you add compound interest to this, because if you start at age 25 or so and invest for 40 years, adding $6,000 per year into the account every single year, you're going to end up with well over $1 million, assuming you get about a 7% return each year. But you only contributed about $240,000 of that $1.2 million. It's a huge difference when you can invest early and consistently to really get those market gains. Now, your IRA and the investments in it really should serve as your backbone for the long term. That is, if you're going to be investing a lot of money, you want to make sure you have your IRA ready to go. So in the event that your other investments fail outside of the IRA, then you still have this sort of backbone, this sort of safety net already built up, so that when you retire, you're at least going to have a good sum of money to actually live off of. And because of compound interest, you can get that number pretty high. But if you set up auto investments into your IRA, you're going to be in a much better position later on, and you can take more risks into other investments because you'll already have this nest egg going. Use that as your foundation. Use your IRA or your retirement account as your foundation for your long-term investing. And then you can take steps from that foundation into other investments. Maybe you want to invest in some real estate, or you want to do stock picking or options trading, and you want to get into more risky investments. You can do your risky stuff on the side, but let your IRA be a more conservative, diversified investment that will get you through retirement and actually get you to your financial goal without so much volatility and without so much stress. That's what I'm doing. I'm using my IRA as a backbone. I'm not using it as all of my investments. Quite frankly, I'm going to be putting more money outside of my IRAs than in them, but I'm always going to be contributing to those IRAs because I never know what's going to happen with my taxable investment accounts, or if my real estate deals go sour or whatever. I don't know what's going to happen with those, but in the event that those fail, I'll at least have this diversified retirement account to lean back on. Even though it might not be the highest returns possible, it should be enough to get me through retirement as long as I'm consistently contributing to them every single year. Anyways, that's all I've got for today. I hope this was a helpful guide for figuring out how to actually get started with opening and investing into an IRA, since it can be a big step for starting your financial journey towards financial independence and actually having a comfortable and prosperous retirement. But if you like this sort of content, definitely subscribe, since I put out new videos every single week about investing, retirement, the markets, real estate investing, and all that sort of stuff. So again, definitely subscribe so you don't miss any of my new updates. And if you haven't used them already, definitely take a look at the links in the description below for Webull and Robinhood. If you open up accounts with those 2 brokerages, you'll actually get some free stocks. It's pretty much risk-free money, so you might as well take it. And then if you really don't want to use those brokerages, you can sell off the stocks and take the money and run, and maybe put it into your IRA that you open up with M1 Finance. But please, just take the free money. It's free stocks on free brokerages, so please, just do it. But until next time, take care.